Hello, everybody, and welcome back. Today, my guest is Christian Solé. Christian is the Deputy Head of European Equities at Candriam. And today, we want to discuss recent developments in the European stock market. Welcome, Christian.
Good morning, Thomas. Good morning, everybody.
Inflation is currently hitting Europe and particularly hard. At the same time, the European Central Bank has only limited scope for interest rate hikes. So what does this mean for European stocks?
Obviously, I'm not a specialist on interest rates. What I would say is basically, I'm not sure that the ECB has so limited scope to raise rates because real rates are negative, meaning that, in an inflationary environment, this is good for leveraged players, so also for leveraged state, because obviously when inflation is increasing your GDP, it means that your debt to GDP is decreasing. So it depends if there is a recession or not. But if you are not in a deep recession, some inflation is good for leveraged players. So I believe the ECB has some room at least to increase somehow rates. The risk, obviously, is a recession, but it may not be related to raising rates. It may also be related to lack of consumer confidence after the Ukrainian war and so on. So all in all, I believe that the ECB has some room and should remain master of the rate environment. This, the consequence for European equities. I'm not entirely negative. It depends how deep the recession can be. So it depends first of the war in Ukraine and how it develops. It depends also on the evolution in the US. But all in all, I wouldn't be too negative on the current economic and equity environment.
Hi there. Just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
China is removing parts of the COVID-19 restrictions, and the European stock market is reacting promptly with some gains. In a larger perspective, how important is this for this supply chain thing for European companies in the European market?
Yes, we've discussed a lot about these supply chain issues. But clearly, first, the reopening of China is a good news for the world economics. Clearly, it makes things smoother and easier for everybody. On a more medium to long-term perspective, it's clear that the COVID, the Ukrainian war, but also other geopolitical issues like the Brexit, for example, have shown to corporates that it's important also to rethink about their just-in-time strategy. Meaning that some corporates either will diversify their suppliers from one country to the other. Maybe they will relocate closer to home some of their production. They will also increase their inventories in order to avoid an issue with the supply chain and to still be able to deliver goods when one of the suppliers is closed for one or the other reason. That's something that corporates will have to think more about in their medium-term strategy, I believe.
From your perspective as a portfolio manager, how has the Russia war against Ukraine affected European equities, and how lasting is the effect of this shock on European stock markets?
As said in my first answer, clearly the question is how deep the war will be, so how far it will go. I mean, will Russia stop at some point? Even if it invades completely Ukraine, can it master or can it occupy Ukraine for many years? Well, we've seen that obviously even the Russian army has some limits, so we may expect they will not attack other countries. It has already proven difficult to invade Ukraine, so we can assume they will not invade other countries, but still. We may have some questions. Also, will they use nuclear weapons and so on? A lot of questions. We believe it should remain limited to the current situation. That's our view. Still, it has negative impact, obviously, first on consumer confidence. It has also negative impacts on commodities, on the prices of commodities, be it wheat, be it oil, be it gas, and so on. And this will impact especially the European the European economy, but also the global economy. This has obviously negative impacts. And the question is, how deep will the recession be in this environment?
What do you expect? So how long will this recession be?
We expect the recession should be relatively moderate, meaning that it shouldn't be a recession as deep as during the great financial crisis that we've known in 2008. Even it should also be more moderate than during the sovereign crisis. If things stay like they are, meaning an invasion of part of Ukraine with maybe some standstill and so on, but in the current environment, we believe it should be a moderate or a mild recession.
The dependency on fossil energy in Europe shall be reduced faster. Which companies will benefit from this transformation?
We've seen it was already one of the themes of the European Commission, for example, and of the European head of states. It was to launch the Green Deal, meaning they were already implementing this Green Deal because we have to manage the energy transition. The Ukrainian war is just accelerating this trend and the need to transit for a greener economy and maybe to use less fossil energies. And the good news is that, partly due to the support of the European Commission and the European state, there is already a lot of players in Europe that are placed, if you want, or corporates that are placed on this energy transition. We can mention, for example, Tomra, active in the recycling and the sorting, selling sorting machines. We can mention Kingspan, that they are active and making the isolation panels. We can mention Alphen Beheer in the Netherlands. They are placing EV chargers across the cities. They are also active in smart grid. This is also quite important in the energy transition. We can also mention some other players, like some other companies like MIPS. They are one of the components in order to increase the safety of bike helmets. Again, it's important that all these companies, a lot of them are leaders in their field, and they are European companies. Maybe they've been supported by some subsidies from the States, but they've been able to develop and are already quite profitable.
You came up with an interesting thesis that small caps do better than large companies in an inflationary environment. What are the reasons for this?
Well, that's what we've seen in the 70s, basically. Maybe the first impact was a deep recession. And we know that during recession, small caps used to do worse than large caps, partly because large caps are used like for safety reasons by portfolio managers, but also because their earnings maybe eat a bit further. What we've seen during the 70s is that from about 74, so 1 or 2 years after the start of rising inflation and rates, small cap have outperformed massively large caps in the US. I'm mentioning the US because it's the only market where we have reliable data on small and large caps. And we believe that it's because smaller companies are more agile. They are more dynamic. It means that they can react more rapidly, in order to cut or increase staff when necessary, or to change their strategy. While in larger companies, obviously, it's more complicated to turn a larger boat than a smaller company.
What criteria do you apply when looking for stocks for your portfolio, and where do you find currently buying opportunities in these difficult times?
The criteria we use is to make sure that we invest in quality companies, meaning that we have a deep analysis and a disciplined analysis of the strengths of the companies, be it the leverage, which is quite important in a rising rate environment, but also we are looking at management and the way they handle their staff. It's quite important, again, to retain people, especially for a small cap. But also for larger companies, it's quite important to retain people in a more difficult environment, especially when it's an inflationary environment, because, clearly staff costs are big issues for companies. So that's one of the criteria we are looking also deeply to is the way they handle their stuff. We are looking also at profitability and competitive advantage. Again, in an inflationary environment, it's quite important for company to be profitable because they are able to, well, at least they are less impacted by the inflationary of cost or supplies as the bigger cushion. And in some scenario, it's even possible for companies with a high profitability to increase their profitability if they have a strong competitive advantage in an inflationary environment.
Are there any certain industries that you currently prefer and that you have a deeper look into?
No, what we've seen recently is in the growth versus value rotation is that a lot of growth and quality names, also growth and quality corporates, have now become relatively cheap versus value names. So a lot of these names, well, 1 or 2 years ago, all these names were too expensive. So we were not even buying them. We see that in the current context, these names have been disregarded by a lot of portfolio managers, or maybe they've been forced to sell, I don't know. And we find a lot of quality and growth stocks that are cheap today.
So this was Christian Solé from Candriam. Thank you very much, Christian, for being with us today and sharing your interesting thoughts.
Thank you, Thomas. Have a good day.